Hey, Coach, could you tell me your opinion of AMD right now?
Right now it's heavy and its level of resistance is 118.57. You're now in the channel of 180, 118.57 down to this 118.24.
Okay, got it. Thank you.
Yep. If it can break through 118.24, your next move's down to this 118.05. And there it is, trying to bounce off of 118.24. See it?
SoFi.
SoFi?
Yeah, maybe it's good time for a short.
Yep, I see it. Yeah, I like the way you're thinking. Yep, I like it as well. 4-cent trailing stop. I just shorted it. By the way, now I'm shorting it with a trailing stop. So in case you guys have ever wanted to know how it looks the other way, this is what I've done. So if you look at my screen, what this means is if you have a margin account, you have the ability to short because you have to borrow, right, the shares. So now what I've done, if you look at the market value, do you see it down here? Show how it shows minus because I've borrowed the money and then I've put in a trailing stop. So now what happens is if this pops up 0.04 cents, that will trigger my stop loss and sell me off. But as long as it continues to go down, just like a regular trailing stop, I'll make money, right? So this is just the opposite of we make money when it goes up, and now we can make money when it goes down with a margin account. If I did not have a margin account, of course, I could have went in here and I went to options and go to puts, right? And then I could have shorted it by using puts, which just means I anticipate it's going to go down. So that's just another way that you can trade, right? Is shorting. Shorting is much, much, much more dangerous than any other trades that exist in the market. The reason is because let's say you were longing and you bought SoFi at $7.27. Okay. So if you bought SoFi at $7.27, your maximum loss you could take on SoFi is $7.27. Let me mute these mics. But if you are in a short position and I bought it at $7.27, my risk is unlimited. You see how that just sold off, by the way? The reason that it's unlimited is because if I'm shorting saying it's going to go down, but then SoFi shoots up to $1,000, right? You see how it's unlimited risk? There's no ceiling to the upside where there's a ceiling to the downside. Does that make sense to everybody?
Yeah. Also, you have to borrow it.
Yep. So what would happen is we call this a short squeeze. If you guys have ever heard of that before, what a short squeeze does is everybody's shorting it, but buying pressure comes in. It drives the stock price to the upside. People can't get out of their short positions. They try to sell, they try to sell, they try to sell. Well, guess what happens when you're selling back your shorts? You're actually continuing to drive the stock market price higher because you're in essence actually buying it back at these different levels. And in turn, the stock keeps going up and people keep trying to buy in to get out. Help, help, help. Oh no, I'm dying, I'm crashing, I'm burning, right? And then that's called a short squeeze and they lose their shirt. That's what happened, by the way, with AMD when it ripped, or I'm sorry, AMC. When AMC went to the moon and you heard about those hedge fund managers losing $4 billion that day, that's why they couldn't get out. Think about it. If you're holding 100,000 shares and you can't buy to get out of there fast enough, but yet the stock prices continue to go up and you're still trying to get rid of them, people have to be buying them to get out of it, and it just keeps driving up and up and up and up, and you can't get out, right? That's called a short squeeze, by the way.